Fed stimulus program continues by www.profitableinvestingtips.com. On news that the Fed stimulus program continues unchanged, the bond market rallied. Yields fell and bond prices rose. Buyers outnumbered sellers as the bond market experienced its biggest one-day jump in nearly 2 years. The Fed stimulus program continues unabated when virtually no one thought that it would. The central bank published minutes of its last meeting at which it decided to continue its $85 billion a month purchase of mortgage securities and treasuries. This policy is widely credited with helping the U.S. economy climb out of the recession and lift the stock market on a months-long rally. Bernanke, the soon-to-leave Fed chairman, gave a press conference just after the info was announced and stated that the economy is not quite to the point where the Fed will choose to start tapering off on its stimulus program. The interpretation of bond traders is that the economy is not likely to pick up enough steam soon enough to prompt the Fed to pull the trigger on a stimulus cutback. The end-of-day 10-year note rate was just under 2.7%, as opposed to around 1.6% in May of 2013, when the market first anticipated a drawback in the quantitative easing stimulus program. Watching the fundamentals. It appears that the Federal Reserve is doing what we continually advise investors to do: fundamental analysis. Putting political concerns aside, it appears that the Fed is going to continue its program of pumping money into the bond market until unemployment improves more and the economy moves further out of recession. On a fundamental analysis note, investors owning dividend stocks will likely see the value of their investments rise as bond yields fall and bond values rise. The current frontrunner to replace Mr. Bernanke at the Fed is Janet Yellen, the Fed vice chairman. Ms. Yellen was instrumental in developing the stimulus policy of quantitative easing. Many experts believe that she will likely follow the conservative course of Mr. Bernanke in not starting too soon or going too fast. As the Fed stimulus program continues, traders will wisely watch the economic fundamentals for clues as to when the pullback will occur. Those who follow the market sentiment instead will likely be caught off guard, as were many who found themselves in short positions and lost money when the Fed acted rationally. When will it end, and to what effect? The Fed stimulus program continues because the U.S. economy is still not totally mended from the damage of the 2008 market crash and ensuing recession. And one of the dangers to the U.S. economy is the huge amount of U.S. debt. On one hand, running up more and more does not seem like a good idea. On the other hand, driving interest rates down has the effect of lessening the interest burden of the U.S. debt. To the extent that the same policy drives down the value of the U.S. dollar, it further reduces the value of U.S. debt held offshore in countries like Japan, Taiwan, and China. These nations and others have routinely manipulated their currencies to keep them weak in relation to the U.S. dollar. This has helped their imports and given them huge currency reserves, primarily in U.S. dollars. To the extent that the Fed stimulus program continues, it may serve to reduce the value of offshore debt to the betterment of the U.S. economy. For more insights and useful information regarding investments and investing, visit www.profitableinvestingtips.com.